tonight for financing your small business. And I have sort of a rough framework of some things that hopefully you'll be able to take away some, good pieces of information that you can take back that may be applicable. But one of the big benefits that I've really found from doing some of these classes is really with the size that we have, we can make it interactive. And the big thing about any type of small business lending is really that there really is no cookie cutter solution. Every business is different and has different challenges and different needs. So by all means, to Miria's point, please, send any questions in chat. Would love to. I think it's probably best if maybe at the end we can kind of go through some of those and make that interactive to kind of address any specific questions or concerns that you're hoping to get out of this tonight. And if there's anything that you want me to either elaborate on or expand on, I'd be happy to talk about at the end, and we can kind of regroup. And again, like I said, customize that a little bit more to what you're hoping to get here tonight. But as Miria said, I'm a commercial lender at Chelsea Groton Bank. I work with a great team of lenders, that really work to really help benefit our community, and really kind of taking on our business owners' challenges as if they're our own. One of the objectives that we really focus in on is really honing into, what the specific need is, and in particular in our world for financing, really finding, what is that need, what's driving that need, and how can we set up something that's not only going to solve that immediate need, but make sure that it's something that's going to work for you in the long run. So I've been with Chelsea now, it's just over 6 years now, and, pretty much have a background in the spectrum of both C&I, construction, and small business lending, that I've been working on here at Chelsea. So we'll skip over this slide pretty quick here. Just so if you need my contact information, there's my email address. Again, happy to follow up with any questions after the presentation. If there's something that kind of dawns on you down the road afterwards, feel free to reach out at any time, and happy to help in any way that I can. So a couple of things that we'll cover today. I think one of the most important things whenever you're looking at any type of financing solution is really finding out what's the right capital structure for both you and your company. That's something that I think is crucial, especially if you're in any type of startup stage. Understanding how that's going to work and what's going to set you up for that long-term growth and objectives that you may have. Where and how to start seeking financing for your company. Important considerations as you're reviewing different options to move forward with. And then bank financing versus third-party agencies, because there are a number of different solutions that are out there and available. And we really work across the spectrum, for different ways to accomplish those goals. And then lastly, just because in normal times, this may not necessarily be something that we'd cover in this session, but I think it's especially important right now in the world that we're in, with everything with COVID-19 related, because that does have a direct impact on your company's capital position, and some strategies to kind of think about as you move forward, given the next whatever the outlook is for the timeline here, just ways to be prepared for that, because that does have a significant impact too as things move forward. So starting off with finding the right capital structure. Really when we look at capital, there's two different forms that you can really use to capitalize a company, and that's debt versus equity. Most companies are going to use some combination of the two, whether it's an existing company or it's a new startup that's being pursued. The impact on the business life cycle, that's also something that's going to be an important consideration. We'll talk about that in a little bit as well, because where the business is in that business life cycle is going to play an important role in terms of what that balance looks like with debt versus equity, especially considering if it's a startup, if it's a mature company. Those are all important things to consider. Lastly, the long-term health of the company. That's something that we've seen over and over as an industry, companies that have taken on different capital structures that will affect the long-term health of the company. And I can tell you examples of companies that maybe were too over leveraged with long-term debt where they really needed short-term debt, and vice versa. And really, when you have some sort of conflict in that structure, that's what really kind of, impacts that long-term growth of the company. So the chart that I wanted to review here, and this is really just a very simple illustration of what I mean when I'm talking about capital structure. When you look at your balance sheet, there's really two sides of the balance sheet. On the one side, you have your assets of the company. So that's going to be your accounts receivable, your cash balances, your equipment, real estate, goodwill, just your brand that you have built up. All of those things are in your assets. And when you're looking at your capital structure, you're really looking at, where's the cash and the funding coming for all of those assets. And that's what I meant by, it's really split up between the debt and the equity portion. And again, finding that right balance between debt and equity is important as you move forward, because, finding the right balance is important, because when you look at that asset composition, for an example, if let's say you have a service-related company that may be, lighter on the assets, you're not going to need as much debt to fund those assets. So in a service-related company, you're not going to have any long-term physical assets. You're not going to have any type of equipment, real estate. Those kind of things are probably less likely. And so in cases like that, your capital structure is probably going to be a little bit more weighted towards the equity side, where if, let's say, you're a large manufacturer, you may be carrying a large sum of receivables, could be a large amount of inventory. And in those kind of things, you're going to see more finance on the debt side, because they are much more asset sensitive, depending on the industry. So with that breakdown, just want to talk a little bit about the debt side of that as well, because, we can dig in deeper here on the debt side, because you really have two forms. Primarily is going to be the short-term and long-term debt. And that's where you're really going to want to try to match your assets to your debt structure. So, back to the example of a manufacturer, they're going to primarily have three different components of assets that are going to need finance. The big one's going to be accounts receivable and inventory. And when you think about the cash cycle for that company, those are short-term assets. So hopefully that inventory is turning over quickly, and hopefully those receivables are being collected quickly. So based on that, the financing need is really going to be a short-term structure. So that's where you're going to want to match that capital structure to be a short-term credit function. So you're going to look at either using your, potentially a line of credit for a short-term solution. A couple other sources of debt that are kind of outside traditional bank financing that could potentially fund that could be accounts payable. For example, if you're collecting your receivables in a, let's say a 30-day turnaround time to collect on your receivables, if your vendors can give you 30 to 45 days to pay on your payables, that could be another source of financing, for your business. And then conversely, you're also going to have that equipment that you're going to need for that manufacturing process. Now that equipment, hopefully it doesn't turn over as often. That's going to be a long-term investment, and that's where you're going to want to use more of a long-term source of debt to fund that. And again, a lot of it has to really do with matching the terms of the asset. So again, you have receivables and inventory. That's probably going to be a shorter turnaround time. So you want to finance that with some type of short-term debt instrument versus, say, equipment, where you're really going to want to match the debt to probably at the longest the life expectancy of that equipment. So if, let's say, the average piece of equipment, say, has a useful life of 10 years, you're going to want to finance that over 10 years or less. Ideally, you'd probably want to be 7 years or less, just to give yourself a cushion there. And the reason we always recommend that and advise that type of debt structure is because we've seen companies in the past where they get into trouble because you could stretch out the amortization on that loan for that company, and it's going to look great for cash flow. You're going to have a lower payment because you have a longer amortization, and it's really going to help in the growth of the company because you're going to have plenty of cash on hand. But the issue that you're going to have is when you get to, say year 7, year 8, year 9, year 10, as that equipment starts to get to that age where it's breaking down more often, potentially needs replacement. If you still have debt on that equipment, you're not going to be well positioned to then go out and acquire that replacement debt. So when I get into, that long-term plan, that's really the idea, is that, ideally in a perfect world, when you get to that stage of that debt amortization, you want to make sure that from a long-term planning perspective, that then sets you up for continued, growth and prosperity. The last thing you want to do is still have a loan on an asset that really has no value at that stage for you. And the last component that we typically see being financed on the asset side is on real estate. And again, that can be done either directly through an operating company, or more commonly, we see that on a real estate holding company, where there's a separate LLC there. But again, real estate is something that's not going to have a 30-day or a 7-year kind of useful life. That's going to have a 20, 30 years useful life. So again, that's something that you're probably going to want to finance over a longer period of time. And again, that's sort of the core principle here and how we kind of match that debt to the asset. But the other component of that is also looking at how that matches in with your cash flow. When we look at what your assets are doing, your assets are there essentially to earn income for the company. So from a cash flow perspective, those assets, they may be high margin yielding. So again, what I mean by that is let's say that asset is generating a product that can generate say a 50% gross profit margin for you. If you have that higher gross profit margin, you could probably afford to amortize that debt a little bit quicker. If you're in a say lower gross profit margin business line, that's perfectly okay too. You just want to make sure that from a debt structure that accommodates that profit margin so that you can continue to have that cash cycle move forward without an issue. So really the considerations here that I think are the big takeaways are, again, matching the debt to the asset in terms of useful life and their turnover. And then also looking at, from a cash flow perspective, is the debt an adequate level for the asset? And what we find a lot of times is in cases where maybe that doesn't necessarily balance correctly, a lot of times that's where the equity comes in, because you can do that, by putting in more capital into the company in the form of equity to reduce that debt service burden incurred by the long-term debt. So I know that's kind of a lot to kind of cover in one quick slide. But again, I'm happy to kind of dig into that a little bit more too, if there's, some specific scenarios that you guys would like to discuss afterwards as well. So again, just getting into kind of where and how to go about looking for financing. Again, there's a number of different sources and places to find that. And again, a lot of it's really going to depend on the life cycle of where you are in the business stage. So I'm just going to jump ahead real quick to this next slide here, because this one really kind of talks about where you would be in that business life cycle stage. So somewhere down here, you're going to see on the horizontal axis time, this is really where the company is starting out. So over here, you might have a startup company, could be a new concept, could be something that's just coming in new to the market. This is just starting out in this phase. They're going to go into the growth phase, which is again where you sort of have the proof of concept. Business is picking up quickly. Your new customer acquisition rate is at a very strong pace. Shakeout is where a lot of times you'll find companies that at this stage, competitors have realized, hey, you've got some strong growth, you've got a great idea, things are moving on. This is where sometimes competitors will come in and kind of level out the market a little bit, and it takes some of that growth out of your forecast. Maturity is where you've reached that stage where it's a mature, stable company. This is where you sort of have the proof of concept. The financials are easily predictable. You kind of know exactly what the market demand is and what your pricing is. And then this little section is called life cycle extension, because this is where really it depends. A lot of times there's companies that they'll see a downward trend because they're going to see either new competition coming into the market, a product that maybe has made theirs now obsolete, or that trend line could change. And, by this one, like you say, life cycle extension, they may be able to reinvent themselves, improve their product, and then continue that growth curve. And again, I've seen some companies that will, at this stage, kind of jump back here again, to again move back into that high growth phase. Any companies that reinvent themselves, come up with a new product, they're gonna see that. So you may see a company that experiences several iterations of its business life cycle. But most importantly, when you look at this, and especially in terms of sourcing financing, is when you look at that in relation to both this line for your cash and then this line for your profit. And it's important to note this, because when you're looking at financing your company, if you're at this startup phase, a lot of companies do a great job of identifying what they're going to need from a capital perspective to start up. What equipment you're going to need to buy, what kind of payment terms to expect. But a lot of things that don't necessarily get factored into that is, if you notice here, cash takes a pretty steep dip. So even though revenues are growing in this phase, your cash levels are coming down, and that's in part because as you grow, exponentially, you need to invest more capital into the company during that initial growth phase to fund those that short-term working capital from your growth. So in that case, that's why you see profits dip with cash, because this is a stage where you have high expenses, startup phase, and you haven't really necessarily achieved that break-even point where you have the revenues to offset that initial investment. If you notice here at this dotted line, you'll see the revenues are finally at that point where they are able to offset those operating expenses. And you're at basically a break-even point here as you head into the growth phase, but your cash position is still much lower at this stage. So that's where a lot of times the highest risk is for, especially a startup, is really bridging the gap, not so much to year one when the company is profitable, which is what a lot of people focus on, but it's really bridging the gap until you're at that break even from a cash standpoint, because until you get that cash flowing in, you've got to find a way to keep everything else flowing during that period where you have that rapid cash investment. So again, when we talk about that long-term financing and long-term health of a company, that's really the objective, is to make sure that you've got a capital structure that can get you past this point. Because once you get past this point, it's really the challenge shifts really to more on how to accommodate the growth. Where down here, you're really focused on how do I cover my operating expenses and reach that point of profitability. Actually, I'll just go back again real quick. So again, just about where and how to seek out financing, that's really the key, is when you're looking at that chart to understand how you bridge that gap to where you're at that cash break-even point. There are a number of ways to do that. And one of them, the straightforward one that I think everybody's probably here for tonight, and that's a little bit more obvious, is you can go to the bank and get, bank financing. And there are a number of different options that are there. But you'll notice this one over here, there's credit cards, because there's a certain element of bootstrapping that can occur during that stage, that's where, again, you're financing that off of, either accounts payable, short-term working capital, those types of things. But again, on anytime you're looking at those, they carry separate risks, particularly on credit cards, for example. We all know that there's higher interest rates there. So again, you want to use those types of things strategically. And again, looking at that capital structure to make sure for the long haul, it's the right setup for you. Obviously there's savings over here. You really want to make sure that anytime there's any type of new venture, that you have that capital in place. So those are really some of the key sources to go for there. But back to kind of the bank financing, the thing that I always like to emphasize is the local relationship piece of that, because there are a number of different ways to source that capital. And particularly by having someone local that you can, have those conversations with to understand what your objectives are is really what's most important. Because like I said at the beginning of the call, every single situation is completely unique and everybody has completely different needs. So really what I find our role as lenders often is really going in and find out what the true need really is and make sure that, we can get you to the right solution. Sometimes that's bank financing, sometimes it's not, but that's okay. The important thing is that we understand exactly what your objective is and how we can get you there. So I apologize, I'm kind of jumping around a little bit, but what I mean by that is, there are a number of agencies that are out there that have, very similar values and objectives to what we have. So, again, like I said, our goal, is really to, get to that need and match the solution for it. So, few agencies that we work with, Sector, Community Investment Corporation, and CEDF, these are local agencies that we partner with. So, in the event that, let's say there's a loan that, we've identified the need, and for some reason there's some hurdle that we're not able to accommodate that request. These agencies are all ones that specifically work with borrowers that do have some specific challenge, and sometimes it's just that it's based off of too heavily off of projections, or it's a concept maybe that we may not be as familiar with. These agencies are specifically set up to handle those types of loan requests that typically can't be done by a traditional bank lender. So, our objective really as sort of a local partner in the community is really to find a way to help you accomplish that goal. And so these agencies are a few of them that we work with specifically to get you to that place where we can get you some financing. Even if it's not through Chelsea, find a solution for you and continue that relationship to work with you. Sector in particular, they're located in southeastern Connecticut. They focus on really job creation, local investment into the community, those types of things where it's really more of an economic driver, for the region. Community Investment Corporation, we use them a lot in conjunction with SBA loans. So there are a number of different SBA products that are available. And specifically, they have a product called, it's the SBA microloan product. And again, these are cases where typically they're loans under 100,000, and they're loans that are really structured to help a company that's either starting up or is facing some immediate growth need. And again, they've been great partners throughout as well. And CEDF, similarly, they're very economic driven. These are agencies that want to see job creation. They want to see you be successful. And the thing that we really value is obviously we place a lot of emphasis on education and opportunity that's out there to learn and grow together. And these agencies also all work within that mission as well. They all have different seminars and different people that can help sit with you to guide you through different challenges. I can tell you with Community Investment Corp, one of their objectives with the SBA product is specifically that there's people that work with you with kind of guidance as you go through. They don't just originate a loan and that's the end of the relationship. They continue to work with you, and they want to hear about the challenges that you face, especially if you're in any type of startup business. They want to hear about those and talk those through with you, because again, as lenders, we all work with a broad base of customers, and you can imagine there are a lot of scenarios that we hear and work with business owners to get through. So to the extent that we can help offer any guidance or assistance through any situations that you're going through, that's really our role as a local lender, is really to be there more as an advisor. I always say anybody can get sort of a loan product with an interest rate. There are a lot of places that you can get that, but really the key is to have that relationship, so you have sort of another advisor in your corner. Same as if you'd pick an attorney, an accountant. These are all people that you're going to rely on as you continue to grow and develop. But again, sorry for the bouncing around a little bit here. I just wanted to make sure we covered a couple of those. So on this page, for important considerations, that's the first step, is really, getting you to the right place, making sure that we've got the right loan product for you and position. But important considerations, this really speaks to the long-term health of the capital structure that you're looking at. So some things to consider are, how does this factor into your future growth plans? And I know that there's another topic or another class set up specifically for business planning. But I always say it's very important that when you start that lending relationship, that you not only go over kind of where you are today and what that immediate need is, but what your future plans are. And as we all know, I mean, everybody can plan, for something, and it doesn't always go that way, and it may not, but in a lot of cases, there are, nuances to the loan structure that could be negotiated or discussed and built in at the start if the lender fully understands where you want to go with your company, and understanding exactly what your objectives are. A few things to consider are, are there going to be additional purchases? A good example of that is, we work with a wide variety of borrowers that just by nature of their business, they need to continually buy new equipment. And there are a number of different reasons for that, but kind of recognizing that what we've done is put into place what's called a CapEx line of credit. And for something like that, it essentially, provides the approval to go out and buy the equipment, and the funding structure is already in place. And as we do the draws for that equipment purchase at a certain period or point in time, that then converts over automatically to a term loan. Those types of structures make it easier to accommodate those types of equipment purchases without really necessarily having to go back and continually underwrite a new loan request, say every couple months when a new equipment need comes up. So again, the idea though is really to get into what's the long-term vision for the company. And like I said, that may not pan out, but that's why, that active communication is so important, so that your lender constantly knows where you're going, what your objectives are, and we can make sure that some of those things that could potentially be a hindrance, we can, potentially work around and solve at the start of the loan, just to make sure that it's positioned for that long-term health of the company. So that actually, that might be a good time real quick just to kind of pause real quick and just see if there's any questions out there or anything that anybody wants to dive in a little bit deeper on. Is there anything? I'm not sure if I'm still learning a little bit with Zoom here, but I just want to make sure if there's anybody that has any questions they want to discuss or catch up on now.
I'm not seeing any in chat, but if anybody has questions, you can feel free to unmute yourself